You've seen this chart. It maps out compound interest, starting near zero and eventually curving dramatically upward into millions of dollars over a few decades. So you run the math on your own situation, open an account, and diligently deposit $150 every single month. A few years later, you log in to check your progress and stare at the screen thinking, is this it? That feeling of frustration is completely valid, but it's not a math error. The compound interest is technically working, but it's operating so slowly that your account balance is virtually indistinguishable from a basic savings account. In 2017, behavioral economist Richard Thaler won a Nobel Prize, partly by documenting something called the feedback gap. It's a psychological mechanism where humans abandon behaviors if they fail to produce visible, immediate results. Because those early investment returns are so microscopic, they fall below our perceptual threshold. Our brains look at the tiny numbers, register no meaningful progress, and conclude that the strategy itself must be broken. The strategy is fine. The standard chart is just an incomplete picture. Wealth building is a process divided into two entirely different mathematical environments, and right now, almost everyone is trapped in phase one. In phase one, you are the engine. The money you manually transfer from your checking account to your brokerage account is the only fuel driving your portfolio forward. This chart proves the physics of this phase. If you invest $200 a month at a realistic 8% annual return, after 10 years of perfect discipline, you have about $36,800. But almost all of that is money you directly deposited. The actual interest you earned from compounding is a shockingly tiny fraction of the total pile. Staring at that slow growth, many people make a dangerous misdiagnosis. They assume their return rate is too low. To fix it, they start chasing speculative, active trading strategies, hoping to hit 16% returns to speed things up. The research is definitive. Data from UC Berkeley, tracking over 60,000 brokerage accounts, found that active retail traders severely underperformed the boring market average. While the market returned about 18%, the most active traders earned 11.4%, primarily due to panic selling and chasing recent performance trends. Aggressively hunting for double-digit returns usually leads to traumatic portfolio drops, wiping out years of baseline compounding potential in a matter of months. When your balance is small, obsessing over your return rate is a mathematical distraction. In phase one, your raw monthly contribution rate is the only lever that actually moves your outcome. There is a specific point in time when your investment returns start generating more cash than your manual deposits. This moment is the phase transition, or the boost threshold. It marks the border where the mathematical rules flip entirely in your favor. The crossover month depends on your contribution, but typically happens between $100,000 and $150,000. Crossing that line triggers phase two. The engine finally runs on its own momentum. An 8% return on $100,000 is $8,000 a year, real income from doing nothing. Every single financial action you take in phase one serves one singular purpose: dragging your total pile of money to that threshold so the math can finally take over. If phase two is where actual wealth is generated, your only strategic mission right now is to accelerate your timeline. You need to hit that threshold as fast as physically possible. Speed matters because time heavily distorts the value of your money. A single dollar invested in month one of your portfolio has a massive 30-year runway to multiply. Contrast that with a single dollar you deposit in year 25. Because it only has 5 years left to grow, that first early dollar holds more than 7 times the raw compounding power of the late dollar. Delaying a contribution increase sacrifices the most powerful, expensive dollars in your entire investing lifespan, the ones with 30 years of compounding runway instead of 5. To definitively diagnose where you stand, pull up your last investment statement. Divide your market returns by your manual contributions. If your deposits account for more than 70, this must be automated to execute the exact same day the money arrives, before lifestyle habits can absorb the new cash. Financial independence is the result of surviving the invisible math of phase one, until the momentum of phase two becomes the dominant force in your life.